and welcome to this kind of sellout event. It's I feel like I'm in the Big Brother house a bit here. It's all a bit bizarre, but I take it you can all hear me well enough. Okay, my name is Marianne Mao and I work for the Institute of Chartered Accountants of England and Wales for their financial reporting faculty. Prior to that, I was working for a company called BPP, where I did training to help people get through their exams. So that's what I did historically. And my job at the Institute is to keep people up to date in the changes that are taking place in UK GAAP. Now, we've only got half an hour, and given the level of change that's taking place, it will be very high level, inevitably, and most of you in this room will have different interests, different backgrounds, and perhaps different places and opportunities that you're exploring. So we'll see how we get on with the timing wise, but I certainly am very happy to take questions afterwards as well. I'll hang around for a bit if you've got anything that you want to ask me. Okay, now what we're going to be looking at in this session, we're going to look at an outline of the UK financial reporting regime, and then we're going to look at some further proposed changes to the regime in respect of small companies. Then we'll have a look in a bit more detail about the new standard that's going to affect most companies, which is IFRS 102. And then we'll consider some of the practical implications of moving, although I will talk about some of the practical implications as we go through. And then very importantly, given that we've only got a limited opportunity to look at some of these changes, I'll talk about some of the resources, a lot of which are freely available, which can help you prepare for those changes. But I'd like to kick off by asking you, please, first of all, how many of you are already aware that there is a new regime in 2015? If you can put your hands up, please. So that's really encouraging. How many of you are aware there are more changes coming for small companies next year? So a smaller handful, but still pretty good, actually. And then some more questions. How many of you are currently applying or expecting to apply IFRS? So that's nobody, actually. So then, which of you are applying, historically, I suppose, the full UK GAAP, so all the FRSs, SAPs, and so on? How many of you are using those? Must be using something if you're not using IFRS. So the majority of you using the FRSI then. Okay, so the vast majority of you are FRSI users. Okay, so it just helps me kind of think about a little bit about what I want to say as we go through this session, what's most important for you guys. Okay, so looking at the regime in overview, so we come from a situation where it is a three-tier regime. We've got IFRS, which is used by the listed companies for their consolidated financial statements. It's voluntarily adopted by other entities, but as a show of hands in the room shows that the voluntary adoption ain't really selling it to most people, so it's not a popular choice for the vast majority of people. And most companies in the UK really are in between these two, using what I would describe as the full UK GAAP, all the old FRSs and what have you. And then you've got a significant amount of people using the FRSI, which is only available for small companies, companies that qualify as small, and that's the majority of you here. Now, the FRSI was amended in, well, last year really, but the regulations came out in 2013 because the government introduced some new regulations, the micro-entity accounts regulations, which exempted micro-entities that qualified for having a very simplified set of accounts. Is anybody aware of those micro-entity regulations? I've got a few nods. Is anybody actually using them? Oh, okay, good. I'll talk to you later. I'd be quite interested to find out how you're finding it. So it is a relatively recent change, and I think what we at ICAW have been doing is to say, well, it's there, but maybe you hold on a bit in terms of deciding which route you go down when we know what the small company reporting landscape is going to look like, which we've got a fair idea about now. Okay, so that is a three-tier regime. So you've got this introduction of the micro-entities. They're currently absorbed within the FRSI, but it's not available to absolutely everybody. It's not just size limits that you need to be able to qualify for the micro-entity regimes. So it's turnover around about the £600,000 mark, balance sheet 316 and 10 employees is your maximum limit. But there are other conditions that you have to meet to be able to qualify for these simplified accounts. Mostly around the fact that you've got to qualify for the small company regime in the first place, so there are a fair few restrictions on that. And bizarrely, but this is the way that the regulations were formulated, you have to be a company. Okay, it's not at the moment available for any other type of entity other than companies, despite a rather confusing terminology there. But if you do qualify, what you have is a very simplified set of accounts which are available to you. They're very simplified and they're also very inflexible. So what we would tend to recommend, and it'd be interested to know what other people are suggesting, is that it is perhaps a default option for the very smallest companies, but on a case-by-case basis, you would need to consider whether that actually meets the needs of the people who are going to be using your accounts, the banks, the creditors, the suppliers, and so on, because it's very restricted in the terms of the information that you can apply. But it's going to be an attractive option as we move into the new regime, I should imagine, for some. Okay, so this year you're all aware then pretty much that we got a new regime for accounting periods beginning on or after the 1st of January 2015. So no change in the companies that have to apply IFRS. There's a new concept which has been introduced, which, given that none of you use IFRS, isn't going to be of much interest, I would have thought. But for UK subsidiaries, basically, who otherwise apply IFRS, there is a reduced disclosure regime which is available, which is basically saying, because all of this disclosure is going to be given in your consolidated accounts anyway, you don't have to produce a lot of this stuff in your individual accounts as well. But that is really for your IFRS companies. Then at the bottom, we still have the FRSI, which is available for now. So asking around the room, that's where most of you are coming from. So you're using the FRSI. That's now here for 2015, but it ain't going to be available for much longer. And then in the middle, you've got your default category then, which is FRS 102. So what we have now is we've got mostly, I think, companies that have been using full UK GAAP in the past will be moving to FRS 102 this year. But what we're going to see is that lots of companies that are applying FRSI still for this year are going to be pushed up into FRS 102 in 2016. So anything that I talk about around FRS 102 is going to be relevant to some of you if you're applying the FRSI this year, okay? And it's going to come in very soon. Okay, so looking at these proposed changes for small companies then, what we're looking at here is changes that are going to happen. There might be some tweaking around the edges, but these changes are coming from the law. So the law comes from Europe originally, but this has now been transposed into UK law. So in March this year, there were some new accounting regulations that came out, and they amended the Companies Act and the existing regulations that we already had. So there is no alternative but to amend the existing standards accordingly, because they have to comply with legislation. So however much we might feel that the FRSI is working all very well, thank you very much, it is inevitable that some changes are going to have to take place because of the law. but also because everything else now in UK reporting is based on an international framework. And if you keep the frizzy, it's kind of this floating thing that doesn't relate to anything else in the financial reporting world. So it's uncomfortable for those people who are used to the frizzy, because it means that we have changed, and most people, we don't like it very much. But for those people who are currently qualifying in IFRS, and most qualifications are in IFRS, going forward, it seems to most people that is the better option in the longer term. Okay, so the FRC proposals are that small companies get absorbed into FRS 102, but with some disclosure exemptions, no recognition and measurement exemptions, purely disclosure exemptions, and then there will be a new financial reporting standards for your micros, the FRS 105, which will presumably, for some of you think, well, I don't like that FRS 102 malarkey, it's got share-based payments in it, it's got deferred tax in it, it's got some fair values in it, so it's going to be an attractive option, but it's still a very restrictive option. So for any company looking to grow, or any company that's part of a group, you probably will end up being pushed up into FRS 102. Okay. Now, another change, which I think will be very welcome to many, is that as part of these new regulations coming from Europe, the thresholds have increased substantially. I've only put the small company thresholds up on the screen because the medium-sized ones, that gives you like 2 exemptions. You know, they're barely worth the paper they're written on. But the small company exemptions are worth a little bit more. And now what you're looking at is revised thresholds which have gone up by more than 50% than they were before. So you're looking at what most of us would think are actually quite substantial companies qualifying as small, which is one of the reasons given by the FRC why for these kind of companies, particularly at the upper edge, using a very restricted set of accounts probably isn't appropriate. So that's, if you like, why we've ended up where we are. Some big companies, or what I would think of as big companies, qualifying as small going forward. Now, those thresholds are available now, but if you want to adopt those thresholds early, you have to adopt everything else early. So theoretically they're available, but you're going to have to use the revised standards that go with them, okay? So you can't, although it's not set in stone yet, you can't say, oh, I'm a small company according to this, and I'd like to adopt the frizzy for 2015. That's not going to work. Disappointing, but that's the way it goes. So I put a question mark against this because they are still proposals. You know, the comment period has only just closed. But if the proposals go ahead as planned, you'll still have the EU IFRS for the listed. You'll still have this thing called the reduced disclosure framework. You'll have FRS 102 expanded to cover the small companies, and then this new standard, FRS 105, basically replacing the frizzy, but not everybody who's using the frizzy at the moment is going to be eligible for this standard or actually going to want to use it necessarily. Okay, they may well want to go up into FRS 102. Okay. So let's now have a look at FRS 102, this new standard which replaces what I would call full UK GAAP. So you used to have this big tome with lots of FRSs, SAPs, UITF abstracts and the like. All of that's gone. Okay, so all of that disappears for the current year to be replaced by this one standard, FRS 102. So it's a much shorter standard. It's much more, for those of you who have looked at it, and I get the impression that some of you may well have flicked through it at the very least, it's a much more manageable standard than the current UK GAAP. But it is unfamiliar. because it's based on the IFRS for SMEs. So from that point of view, there will be a learning curve. And on top of that, I think one of the things that people are beginning to find a little bit uncomfortable is that a shorter standard comes at a price. It comes, and the price is that if you get less things telling you exactly what to do, you've got to exercise your professional judgment. You're going to have to look at the facts and circumstances and say, well, for me, this is what I think gives a true and fair view. So true and fair view is still there. You have to prepare accounts that give a true and fair view, but it's inevitably, it's less prescriptive, sorry, try and get my words out there, less prescriptive than what we had before. Okay, so what we're looking at then when you move to FRS 102, for most of you then, by the sound of things, that will be in 2016 if you're moving from the Frizzy, but 2015 if you're coming from full UK GAAP, is that full retrospective application is the norm. So that means you have to restate everything that appears in your first set of accounts retrospectively. Now, I'll talk a little bit more about that at the end. It sounds perhaps a little bit worse than it actually is, because for many of you, not very much will actually change. But until you actually look at it, you won't know. You've got to go through the process of working out what the changes will be. There are a few exceptions to retrospective application, but I say few advisedly. Really important is the optional exemptions. There are about 17 optional exemptions to applying everything retrospectively, and they are there to be pragmatic, to help you on your way. So a really good example is consolidations. You've prepared consolidations perhaps using old UK GAAP. The rules under FRS 102 are different. For example, merger accounting isn't available. So do you have to go back and restate all of those old acquisitions? No, you don't. You take advantage of that exemption, but any new acquisitions that you make will have to be done under the new rules. So those exemptions are there to make your life easier. It's a cost-benefit thing. You know, it really isn't worth trying to restate any of this, or it just won't be possible because you don't have the information available anymore. And then when you come to prepare your accounts, you're going to have to explain what changes have been made to those accounts compared to what you published last year. Okay, now, you're probably aware of this already, but just in case, FRS 102 is based on the IFRS for SMEs. The IFRS for SMEs is a simplified version of IFRS, a very much simplified version. But when that was consulted upon, it was clear that it wasn't quite fit for purpose. So it's been made wider in scope and with more options than you have under the IFRS for SMEs. So what you're looking at is something which is actually more flexible than the international equivalent. It's in 35 sections, and personally I find it easier to use than the old UK GAAP, because it's rather like having a study text saying section 1 is scope, section 2 is principles, section 3 is financial statements. Now don't quote me on that, I can't remember what the section numbers are, but you get the idea. You have a chapter on fixed assets, you have a chapter on impairments, you have a chapter on share-based payments, whatever it happens to be. Now, when it comes to preparing your first set of accounts under FRS 102, they're not going to look vastly different to anything that you're preparing at the moment. Now, the language that's being used here may need you to get a little bit used to them, because they're the terms that come from the International Financial Reporting Standards. So it uses the term statement of financial position, but we tend to use the term balance sheet. But there's nothing in the accounts which says that you have to call it a statement of financial position. So if you want to carry on using those old terms, you go ahead, and in any event, at the moment, the Companies Act pretty much dictates the terms that you use. Okay? So it sounds different, but it isn't going to look very different when it actually comes down to applying it. There are some differences, though, in terms of instead of the statement of being a note at the moment, your changes in equity, it will now be a statement of changes in equity. That's kind of, it's a bit of fiddling around the edges, really, to comply with the new standard. Okay, so in terms of the actual, when you pick it up, it's not, I think, going to look dramatically different. It should look recognisable. But as I've mentioned before, the language will be different. So the standard talks about inventories, as will FRS 105 in due course. We'll talk about inventories rather than the stock because the language is going to flow through. And there are now changes afoot in these regulations that have just come out, which will mean that in due course you can also use the terms inventories in your accounts if you want to. Okay, so increased flexibility has been introduced with these new regulations that have just come out. So that's up to you, though. That will be up to you to decide what is preferable for your purposes. Now, here I have to have a health warning, because what are the major differences are very much going to depend on your individual circumstances. This is what we have identified as generally being the big hitters. But if you don't have any investment properties, then it's of no relevance. If you don't have any leases, you don't care. If you don't do any consolidations, none of this matters. But the devil is in the detail, as always, so you have to look through the standard to work out what the differences are for you. So I'm going to look a little bit more at financial instruments because that tends to give people nervous twitches. I'm going to look a little bit about goodwill because there's a lot of misinformation, I think, is the best way to describe it, going on about what's happening to the accounting treatment for goodwill. And I will also mention deferred tax because that's likely to affect everybody. Now, if you're currently on full UK GAAP, and none of you said that you were, there wouldn't be a move in respect to share-based payments. But if you're coming from the FRSI, then there are exemptions in the FRSI because of in relation to share-based payments. They won't be available for those FRSI users moving to FRS 102 going forward. Okay, so that's very much an overview. It depends on the individual company, inevitably. Okay, financial instruments. Now, there has to be some myth breaking around financial instruments. And the first myth is really that simple companies don't have them. Well, that isn't true. It can't be true, but because financial instruments includes debtors, creditors, bank loans, and the like. So name me a company that doesn't have those. But what you then can have to reassure you is that for most of those standard financial instruments, you don't actually have to do anything different. So another myth, I suppose, is that there's lots of fair values in FRS 102. There are more than we're used to, but it isn't pervasive throughout FRS 102. So for a lot of simple companies, you won't have any fair values that you have to use at all. However, having said that, there is a small change if you happen to have any investments. They will have to be put in at market values. But one of the things that's really important to appreciate now, even if you're a FRSI company only looking to move to this in 2016, there are instruments out there which you think, well, they're very common, so they can't be complex, can they? Well, they are complex in terms of or other, to use a FRS 102 term, when it comes to the accounting treatment under FRS 102. And what I'm thinking of specifically is things like interest rate swaps, which are not uncommon, foreign currency futures contracts, even some small businesses enter into those arrangements. And they must do, otherwise we wouldn't have these mis-selling scandals that we do at the moment. So it must be that people in the smaller businesses are using those because the banks were selling them left, right and centre to anybody who was willing to listen. So this is something that will be new. You have to put a value on those, but the organisation that sold you those instruments should be able to value those for you. They should know what they're worth. They should know what the potential gain is or loss is on those contracts. So what you need to do if you have those is to go to whoever sold you them and say, okay, what's the value I need to ascribe to those in my balance sheet? And then the movement then will go through profit or loss. And the other thing that I will mention here, which is really important, that some loan arrangements, which may seem kind of common or garden to some, can also potentially fall into this category. So if you've got a standard variable rate loan or a fixed rate loan, they will be basic, okay? But any kind of odd clauses in there, you're going to have to watch out and you're going to have to look at them very carefully. And what I would say to you is that whoever is sorting out the financing of that business needs to know about this. Because really what you need to say is just stop there a minute before you agree to that loan. Because if you accept that loan, if you agree to it, we may be in all kinds of trouble when it comes to our accounts. Now, I don't want to overstate it because the valuations are available. But why cause yourself grief when you could be in the basic category? So watch out for those. Make sure that the people who are arranging the financing are aware of this. Okay. A little bit about goodwill. I'm hearing and reading everywhere that FRS 102 says that the useful life cannot be more than 5 years. That is not true, and it will continue to be not true, because you should have had a goodwill. Now, it may not be right, but you should have had an accounting policy which you could justify in your accounts when you were writing off goodwill before. Now, if you don't, I can't answer that question. But it's only in those circumstances where you can't come up with any evidence to support your remaining useful life of goodwill that you're going to have to write it off over 5 years or less. It is not the case that you have to write off in 5 years or less, whatever the circumstances. And the last specific difference that I wanted to mention is deferred tax. Now, for deferred tax, you will have more of it. Actually, looking at the slide, I'm not terribly sure it's very helpful. FRS 19 uses what's called a timing differences approach. And they talk about FRS 102 having a timing differences plus approach. Actually, more useful is that FRS 19 has lots of exemptions or exceptions where you don't have to provide deferred tax. So it says you provide deferred tax on timing differences, but not for A, B, C, and D. So basically A, B, C, and D have gone. Those exceptions no longer exist. So what you're going to be looking at in deferred tax is if you have an accounting policy of revaluing, you're going to have to provide deferred tax on those revaluation gains. Similarly, if you've got anything that's being accounted for at fair value, you're going to have to account for deferred tax there. And if you have been consolidating the profits of associates, subsidiaries and joint ventures, and they haven't been remitted back to the UK, there might be some deferred tax to provide there as well. So more deferred tax is highly likely if you're in any of those situations. Yeah.
On first adopting,
yeah,
are we going to have to then provide for deferred tax on
yes.
revaluation reserves?
Yes.
Right.
You are. And you'll do it as a transition adjustment. I'm moving on to that in a second, actually, but you'll do it as an adjustment to your opening reserves. So if you were applying it in 2015, for sake of argument, it would be the 1st of January 2014 that you would be adjusting, because you go right back to restate your comparative figures as well.
Against the reserve or against P&L reserves?
Against your reserves. Because the normal rule for deferred tax is that the accounting treatment of deferred tax follows whatever the accounting treatment for the transaction that gave rise to it.
It's a struggle justification, right?
Yeah. So, but you're not because it's an adjustment to reserves. You're not going to present it in the struggle. It will just be an opening adjustment against your reserves, and it will be against your revaluation reserve. Because gradually it will realise, in the same way as you'll unwind the depreciation, you'll unwind the deferred tax that goes with it as well. No, I'll come back to you. Take my word for it, because the revaluation reserve does eventually get realised, and the deferred tax will go alongside it. It will. Okay, so practical implications. So I've talked a lot about this already as I've gone through, but just to kind of bring it together a little bit. So I've done it on the basis of 2015. If it was a frizzy company moving in 2016, all of these dates would move on a year, okay? So what you're looking is, you're going to be preparing your first set of accounts for FRS 102 at this year end, given a 31st December year end, that is. So what you're going to have to do is you're going to have to restate everything retrospectively. So you're going to have to restate your comparative balance sheet. You're going to have to restate your comparative P&L account. And you're going to have to restate your opening equity. Okay? So one of the things would be things like any fair value adjustments, any deferred tax and the like. You'd have to do that as at the 1st of January 2014. And then, as I've already mentioned, you would have to provide additional information, because particularly in respect of those 2014 accounts, which were prepared under your old UK GAAP, what's going to appear as your comparative information could potentially be different. Now, there are a lot of companies that are going to go through this process and find no difference at all, okay? But you've got to go through considering whether that might be the case. Okay, so here is our suggested approach. You know, how do you make sense of all of this? You've got to start by reading the standard, sad but true, okay, no escaping it, I'm afraid. And then you've got to think about what accounting policies are appropriate for your business. So you've got to start by looking at what your business does and the contracts it enters into. You can't just start with your trial balance, because some of things will have been off balance sheet before. So you've got to go back to a more basic level and think, what contracts do I enter into? What transactions do I enter into? And it may be that your current accounting policies are absolutely fine, but actually it's also an opportunity to perhaps revisit and refresh and think, actually, maybe I can come up with something better now. Or you might actually have to change. Then you want to look back and see if there's any opportunity to avoid having to restate retrospectively. So in section 35, that's where you'll find all the exceptions and exemptions. You need to think about which would be useful. And there is a handful which will be truly useful to a lot of people. Then you've really got to think about some of the wider implications, because these adjustments will ultimately affect things like your distributable profits and your tax and your financing arrangements as well. It could affect things like profit-related pay, your bank covenants. All of these things come into play. So once you've got some idea of what adjustments you might have, you do have to think about the wider ramifications, things like dividend payments and the like. And then you really got to think, okay, what are my priorities here? And your priorities have to be for the things that require you to gather information. Because the more you go into the future, the harder it's going to be to go backwards and say to the bank, oh, I did something on the 31st of March 2014. Can you tell me what the value is? That's going to be tough. Ask them now, or even better, ask them before the actual date. You know that you need the information for the balance sheet date. Warn the banks that you're going to need that information. So that would be, I think, a reasonable way of planning ahead. And it is more than an accounting change. So we're here in the Sage arena, so obviously the software companies are all over this and looking at how to update the software packages. Your employees, if there are accountants in the organisations, they will need to be trained, but also those people negotiating contracts, looking at the financing of the companies, all of that. If those contracts have accounting ramifications, the employees in charge of those contracts also need to have some kind of awareness of the ramifications of what they're doing. Your banks need to know what you're doing, your investors need to know what they're doing, because the information's going to change. Implications for individual transactions I feel I've covered, and dividend and tax, again, I've already mentioned, but you need to think about all of those changes. It's not just about the profit or loss at the end of the day. Now, when you're then kind of perhaps reeling from the level of change, and as I think I mentioned before, I don't want to do any scaremongering, because for a lot of people, you could come out of this process and end up with actually negligible change, but you have to read the standards. It's important to know what's available out there that you can use. First of all, you've got the FRC website, okay? They have lots of information which is freely available for you to download. So all of the standards are available for you to download for free. And you can get all the proposals there as well. All the exposure drafts relating to the small company stuff are on their website. And they also have a suite of education notes. There's 15 of them, 16 shortly. There's another one due to come out. So you can go to their site, and there's quite a lot of resources there available for free. We at the Institute of Chartered Accountants also have a part of our website dedicated to the new UK GAAP. Now, it's split between freely available products and some which are behind a paywall, but there is information on there, and you don't have to be an Institute member to access them. I think all professionals are interested that this goes as smoothly as possible. That's in all our interests. So if you go to icaw.com new UK GAAP, it will take you straight to that part of the website where you'll find the resources that we produce. And one of the things that we produce is a series of FAQ documents which anybody can download. And what we also have, again, freely available to anybody who's interested, we have an app which is free to download, and we only update it, I would say, once every 2 weeks or so. We don't bombard you with information. We only put in there things which we really think of interest to the generality of the public, okay? So it's not just for the geeks, is what I'm trying to say. And it's similar to the Twitter account. It costs nothing to subscribe to our Twitter account, and we'll keep you up to date on any changes, and also when new resources become available, we'll also tweet and put those on the app so you know what you can access. Okay, so I hope you found that helpful. I know it's kind of a whistle-stop tour, and I hope I haven't spoken too fast. It's really difficult when you know that there's a lot to get through. So a reminder of that we've gone from a 3-tier regime to a 4-tier regime to a possibly 5-tier regime. So on the face of it, it looks more complicated, but it's based on the idea that you start small, and if you grow, you've got a natural progression upwards because it's all based on the same principles. Those small changes are obviously important to everybody in the room here, coming in 2016 with early adoption possible as soon as those standards become available, which is expected in July, well, summer of this year, shall we be on the safe side. A reminder of the FRS 102, new standard which most people are going to be applying, and then a little bit about the practical implications. So thank you very much for your attention.